So this is Christopher Calandra, Certified Financial Planner with Elliott Wealth Management Services. Thanks for listening to this. I'm recording this on the evening of March 9th, 2020. This is after the market was completely routed today, with the major market averages down between 7 and 9%. A lot of fear in the market, which we're going to talk about with my guest, Dean Nicholson. Just a lot of fear, especially today. This market sell-off had started a few weeks ago with the spread of the coronavirus. What also influenced the market today was a huge drop in oil prices created by a disagreement in production between Russia and OPEC, and that got an already jittery market just that much more panicky. So it was just a very rough day. So I have with me Dean Nicholson. He's an economist. He is a retired financial advisor. Many of you probably know I took over his practice a few years ago, and we talk fairly regularly, especially when the market is spooked. We had done an interview like this back in 2018, the last time the market had a notable correction. And I asked him to spend a few minutes with me tonight to talk about today's action. So, Dean, thanks for joining me.
Not a problem. Certainly a good day to be contacting clients.
Yeah. So the first question is, with today's action, it seemed like people were more fearful, and today was more irrational and panicky than I've seen the market since the great financial crisis. Was that your assessment too?
Absolutely. For the last 30 years, I've been through 6 declines of more than 20%. And each of them had really an economic factor involved. And this one is more emotion and fear than anything I've seen in all these previous years.
Yeah, I think so too. I'm sad to say that I worked through all of those market downturns too.
Yeah.
It's hard to ever get used to them. They are. I'll stay unemotional and make rational decisions and be a professional, but these times are very hard. You joked off air about how pleased you are that you're out of the game, because these days are difficult for everybody that's involved, and it's difficult for me. I'm entrusted with so much responsibility for my clients, and I do not want to disappoint my clients, who I very often have a personal relationship with, not just professional assurances that I will do a good job for them. This is tough stuff, right?
Absolutely. The only thing that we have behind us is years of professional attention in the market. And all I've seen in the past 30 years are recoveries after events like today. I mean, the average recovery time is between 18 months, and the longest recovery was 4 years, but that was doubling the market from where it was before the correction occurred. So the market will come back to sanity after the fear subsides, and you're investing in the economy. The U.S. economy is still strong. The world economy is weaker, and some health systems are very much less than ours, but the U.S. market is still going to continue to be the market to be in, and long-term investors should stay the course. You get rewarded for time in the market, not try to time the market.
Sure.
Stay in the market, you're going to be successful.
So that adage has been around a long time. This, as you said, is a little different, because what's driving this sentiment and this fear is not just the business of, is a company going to fail? What's happening with tax policy, with trade policy? Is the consumer strong or weak? But you have this overlay of a healthcare crisis, and that really makes this different, at least in sentiment and PR and capturing people's attention more than other episodes, right?
Absolutely. People fear the unknown, and this is a virus that is unknown. So people who are conservative and human beings react innately when they're faced with something that they've never seen before and they're uncertain about it. And that's what's happening, and they're taking the money out of the market because the condition is something they've never seen before. Now, there's not a good reason to do so, by the way.
Yeah, I mean, it seems to me what I've been sharing with clients as I've touched base with a lot of people today and people calling, and is it seems like the market should have reacted badly to the coronavirus. That, I think there's little doubt. But it does seem to me at this point, especially after today's very rough episode, that this is overdone, it seems to me, and the sell-off is not very rational, but sentiment. That there's just indiscriminate selling, and it's selling and asking questions later, which might mean that we're closer to a bottom than the top. Not that I have a crystal ball. I do not have powers of figuring out exactly what's going to happen. But I think trend-wise, it seems like we're getting a little overdone on this sell-off. What do you think about that opinion?
Oh, absolutely. When you have things that occurring that normally would cause the market to go up, the cutting in the interest rate by the Federal Reserve in the lower price of oil, which is actually good for the majority of people in the United States, the market goes down. Now, the market went up previously on times of bad news because of a consideration of how strong the U.S. economy is. So people tend to overreact in either direction, and unfortunately, they sometimes assume that once something is starting, it's going to continue doing that forever because of inertia, and that's exactly the opposite of what's going to happen. So I predicted the recovery is going to be quick and violent, but I'm not sure when it's going to occur. But you have to stay in, because if you miss one of the key days in the recovery, you'll never recover. So
yes.
I think you got to stay in and stay the course.
I think for most people, most of the time, that's the right situation. If we had a crystal ball, I mean, shoot, I wish that we had done some selling when the coronavirus first reared its ugly head and spread to the U.S. And in hindsight, it was a mistake. However, the H1N1 swine flu from a few years ago killed way more people than it seems like coronavirus is going to kill today. And listen, it's tragic for anybody to lose their life to the coronavirus, and I certainly don't want to contract it, and I wouldn't want anyone to contract it. But when you just look purely at the numbers, it seems like this is less deadly than the H1N1 swine flu, which I think killed 400,000 people worldwide. And to this point, we're nowhere near that number. Now, maybe we get there, but there wasn't this uproar. I mean, it didn't capture the media's attention in the same way. It didn't capture Americans' fears in the same way. But we were fine through that. And before that, there was SARS and MERS. There's been other viruses that have come about that have had healthcare impacts with people contracting the disease and pass away. But this seems to really have people worried. Why do you think that is? I mean, one easy thing is to blame the media, and I think there's something to that, but it can't be completely just the media's fault, right?
No, it isn't completely, but an analogy would be if you're a parent, the peer pressure is so strong that regardless of how good your parenting may be, there may be some deleterious effects because of peer pressure. And social media is a culprit here as well, because basically young people and even middle-aged people are using social media tremendously, and that just makes a small blip go into a huge uproar. So, I think that has a big part of it, actually. They're hammered with information that may not be actually accurate, but they're being influenced too much by the media. It's a sad situation.
So do you think, you mentioned that a lot of times people think like if the trend is up, it'll continue to go up, and when the trend is down, it'll continue to go down, and the markets is messier than that. So what is it going to take? Could you think of some things that might happen to shake the market from this really worried state and get some type of recovery in place? Now, the Federal Reserve cut interest rates 0.5 point last week, and it really had no effect. And you mentioned a moment ago that the oil price coming down over the course of our careers, which is what, a combined 50, 60, maybe 70 years? I don't know.
Yeah, unfortunately.
Yeah, right. Is typically when oil price comes down, that's good for economies, acting almost like a tax cut for businesses, and it's good for the consumer, again, acting as a tax cut, but the market just completely shrugged that off. And in a similar vein, last week with the Fed cutting interest rates, oftentimes that spurs the market, spurs the economy with lower interest rates, but we're not seeing that happen. That's probably due to some of the emotion that's going on. But any ideas of what the government or what the market may need to see a little bit of a turnaround and to turn the tide against this fearful selling?
Well, I think one of the things is that when people develop more trust and confidence in the action taken by states and by countries together, and the more good news they have about like less events occurring in China, in Italy taking somewhat drastic but probably prudent steps regarding it, every little bit step is going to reinforce the fact that this may not be as bad as I think it's going to be. And I think when you have the Democrats and the Republicans both agreeing that the fact this is a serious matter and acting actually for the benefit of every resident is versus a Democrat versus Republican, people are going to have more and more confidence. I think it's just going to be good news regarding the control measures that's going to build the individual's trust back in the market, which is really nonsensical, but I think that's what's going to occur.
So I think at this point in the United States, there's been, I believe, around 78 deaths, all of them tragic, but a small number, given that the country has over 330 million people in it. I think worldwide, deaths are below 4,000, the majority of them in China, and it seems like the deaths in China were in the earlier phase of what the coronavirus was delivering to us in terms of the news and arriving on the scene. So what if we get, a week or two down the line and the death toll has not increased much? In your opinion, and I know we're speculating now, but in your opinion, how impactful would that be on market sentiment if the death toll, not just in the U.S. but internationally, doesn't grow exponentially?
It's going to be a big impetus for quick market reaction on the positive side, because people, that's what they're looking for. They're looking for good news, and when they hear it, it's going to keep reinforcing, because people realize you've got to get back into the market if you're going to make money in the market. You have to be in the market. You're not going to make money if you're not in the market. And most people who've taken the money out realize that they've got to get the money back in, and they want to get the rise as much as they can. So in self-interest, they're going to be interested in getting back into the market. So the more good news you have, the faster and more dramatic the recovery is going to be.
And if the Federal Reserve cuts interest rates again, I think they're meeting here in a few weeks, how much does that do to turn around the market sentiment? I'm skeptical if that would have much of an impact. What do you think about that?
I think you're going to have the good news first. All right, the good news has to come first. Otherwise, it's going to just reinforce how serious it is and make the condition even worse than it is right now. Because that's a good thing for a professional to look at it, but for the non-professional, you're thinking, oh my God, it must be deadly serious if they're going to lower interest rates again. So it's kind of a mix between the emotion and the reality what's happening.
It has to be accompanied by some other good news. It can't turn the tide by itself. Is that your point?
Absolutely.
All right.
Absolutely.
I like that. Now I'm perusing the news as we're talking. Again, this is like 8 p.m. the night of March 9th that we're recording this. Is that President Trump floated the idea of a payroll tax cut, which I think was tried during the financial crisis, if I remember correctly, something that George W. Bush and the administration and Congress did. How does that strike you?
Well, I think it's well intended, but the problem is that some people are losing a lot of business. Like here in Orlando, in Florida, a lot of cancellations have occurred, which cost the city of Orlando, millions of dollars and probably thousands of jobs. Now, if you cut the payroll taxes and you don't have any work, that's not going to be that big a factor. But psychologically, it's just saying, yes, the government has its acting gear and they are doing things to help us in the recovery. Is it really going to help all that much? I don't think so, actually, but it is a very positive thing, and I'm glad he did it.
Now in 2008, Warren Buffett, who wields a lot of influence given his unbelievable track record, and I think generally speaking, Americans have a very high opinion of him. Towards the bottom in 2008, he came out and said, I think, it's time to buy. And I'm paraphrasing. That's not a direct quote. Yeah. But it really had an impact, and it helped get the market back in the Great Recession off the floor. Do you think that can happen if a high-profile individual who commands respect came forward and said, I'm buying and you should too?
Yes. As professionals, I've always tried to buy when the market's down. You and I have talked about this earlier. The stock market's the only place when a market has lower prices that people don't buy. All right. So now is the time. If you're a long-term investor, you have to stay disciplined and look at your objective. The prices you want to be aware of is, especially the price you sell something is when you sell it. If you're not going to sell it, then don't worry about it, because time in the market is going to take care of almost all illnesses. Time is going to heal the market. So if you don't need the money, don't sell it. And Buffett has a great reputation, and people are going to take a look and say, well, he knows what he's doing more than I do, so if he's buying, I think I'll buy too. So I think it's a positive thing.
Now, we're talking somewhat optimistically about hold. I think that we're closer to the bottom than the top. You seem to agree that a lot of this is emotional and will sort itself out over time, and that patience will get rewarded. But I did speak with a good friend of mine earlier today who's not in industry, and he predicted that this would be as bad as the great financial crisis. His thinking was that if the coronavirus news stays in, if the coronavirus topic stays in the news for 30 days, that things will continue to unwind in the economy and in the markets, and that the worst is yet to come. And I wouldn't discount that completely. I disagree, but if the coronavirus numbers, both infected individuals and fatalities, not just in the U.S. but worldwide, if they really went up significantly, I think that maybe things could get worse before they get better. I would disagree with him, but I don't think that's as far-fetched as I felt about it a week ago or 10 days ago. What do you think? What do you think about that very pessimistic, bearish sentiment that things are going to get way worse? Now, the market's off about 20% from about 17% maybe from its peak earlier this year. It's down less than that for the year, because January and most of February the market was up, so it's given back those gains and then some. But during the great financial crisis, the market was down 45%. We had lots of massive company failures and the financial crisis that was close to not working at all. It was a very, very severe situation. But what do you think about my friend Jeff's very negative outlook?
I'm not as negative. Our economy and the businesses in it surprised me, even being an economist for 30 years. When Trump was using tariffs, I thought not the sky was going to fall, but I was very seriously concerned about it. But I've been amazed at how well U.S. businesses have been able to find solutions to the problem of tariffs, and earnings did not go down significantly. And I think the same thing is that you can never underestimate the power of capitalism. Our economy works. We won 2 world wars simply because we outproduce the adversaries. And the U.S. economy is still basically strong because when someone in the U.S. wants something, they buy it. Half the time they buy it, they don't even have the money. They're willing to borrow it because they want it, and they want it now. And consumer spending is critical. And I don't think it's going to be deleteriously harmed as long as the coronavirus does not go crazy in the U.S.
Right. So spending may slow for a bit, but it will spring ahead later when the coast is clear. That reduction in demand, people spending less. You could make the case that if the coronavirus doesn't worsen dramatically and we get past it relatively unscathed in terms of infected people and especially in terms of fatalities, that that demand will come roaring back, especially with lower oil prices, lower interest rates, and the economy was rip-roaring. I mean, the jobs number from February was outstanding. I think it was 263,000, and the government revised upward the December and January job numbers by 243,000. So, the economy is going to slow down because of this. But I don't know if it'll stall completely, and I'm not convinced, different than my friend Jeff, that the market may not come back and the economy and the consumer may not come back pretty strongly once this coronavirus situation works itself out. I'm hoping the mobilization of this country, where people are paying attention to it like I've never seen in my whole life, with Clorox wipes and Purell, and being careful about shaking hands and hugging and washing their hands, that this mobilization will pay off here as well as around the world. But these are difficult times, and you could understand completely why clients would be nervous and anxiety-filled over these sell-offs and these headline news, right?
Absolutely. I just think it's important to every client to make sure that you, their advisor, know when you might have to sell some of their portfolio for whatever reason.
Yeah.
The only time you can get hurt if you have to sell something when the market's down. If you don't need anything immediately to liquidate, then don't liquidate it. And you should let us know when you do so we can plan ahead. Because if someone has a shorter time frame than a year or two when they need money, well, we're going to set aside that money because you can't count on the return in the market for a year. You can't. And it's unethical to even try. So it's just critical that your clients let you know when you think they're going to need monies for whatever reason. Of course, sometimes you don't know, but that's the most important thing you can do to be successful and live through these downturns.
Very good. Well, Dean, this was a good discussion. I appreciate it. I think you bring a wonderful perspective, and I like kicking it around with you. This was a long day for me. I'm on high alert, and I'm sensitive to the worries of my clients, and we want to act with integrity and professionalism at all times. And for most people, most of the time, at least for now, I think holding and or buying is the best course of action, and that patience will be rewarded. Although I leave open the possibility that I will have a change of opinion. Things are very fluid, and that's not to say that it might not make sense to sell at some point during this episode. I'm not morally opposed to it, or I'm so rigid that I can't foresee any time that that would happen. But at this point, at this juncture, I think for most people, most of the time, holding is the right course. Hold your nose, walk through this difficult period, and it will pass, and you'll be rewarded on the other side, not 40 years down the line, but a few years down the line. So, Dean, thank you again. I know it's late. I appreciate the time and the friendship. Thanks for the discussion.
Well, thank you for the opportunity, Dean. I know you're going to do the right thing for your clients.